All right, Venugopal Garre is with us, Managing Director and Head of Research India at Bernstein. Venu has been, of course, expressing his wonder at how strong and how hard the market has been rallying through his notes. Some of them really sharp and pointedly expressing his views. Venu, so you're coming back after a while. So why don't you tell us what you're making of things before we really delve into some of the finer aspects of PEs and earnings estimates, etc. Go on.
Thanks, Prashant. Yeah, I mean, the market resilience has primarily been pretty interesting. Now, it's interesting because the fundamental reality is that you're not really seeing any earnings growth acceleration. And more importantly, you're not even seeing earnings upgrades. The only difference is that we're still in a decent macro cycle. Earnings growth are decent, even if they are slower than what we actually saw in the previous 2 years. Now, the reality is that whatever the framework be, it's very tough to justify stocks across the board from a valuation standpoint. And it's actually very tough to justify them even from long-term measures. So what is essentially happening at this juncture is the broader macro strength, which I think is fairly visible for the next few years, is ensuring that the domestic flows sort of remains resilient and actually been very strong. It's not just sort of bringing up or pushing up markets. It's also ensuring that a lot of the broader IPOs that you're seeing and stake sales that you're seeing are also getting digested. So that is a fundamental reality at this juncture. So somewhere down the line, one still has to participate in these markets. You can't be really off these markets. So people like us also figure out creative and imaginative mechanisms to ensure that we remain buy on certain stocks and push some ideas. So that's where we are.
Right. Very interesting there, because I was just looking at your note and it's exactly what you're saying right now. Most investors appeared uncomfortable with market levels, but investing continues with cash levels not being raised. What's interesting is that you've dissected this phase-wise. The phase one is where there is phase of denial, where a strong macro and earnings outlook drives a re-rating. That has happened. Towards the end, you then start to see acceptance of these valuations. That's phase two. Rational investing still prevails. Then you're talking about the invincibility phase, where public market investors start to think like venture funds, and the era of imagination commences. Do you reckon we're in phase three, and what typically happens after phase three?
So that is something which, out of a bout of frustration, we had put across in a recent report to sort of timeline the sort of a market cycle. And actually, I've seen that in the past as well. We're all like pretty old hands at the market. I think we are just about heading into phase three. Phase two and phase three, I do still see some degree of rational voices in the market. But this juncture, early stage phase three, and I think this phase three could last for a while. And what happens after a phase three is very clear that you primarily reach a situation of a bubble, which when pricked, but you need an external catalyst to prick it, then there is a collapse. And I have a slightly different view on the collapse this time, because one of the perspectives that I have at this juncture is the fact that broadly, there is a willingness to, sort of give high Ps to stocks rather than high earnings, right? So what it means is earnings upgrades are not necessarily the driver for the market. So when the collapse happens, you're not going to see a massive earnings-led collapse. It's going to be just valuations tempering down materially. So that's basically what we see post phase three.
Okay. So Venu, so what's the sense from here on? And if indeed we are going to get into a period of muted performance or underperformance, then is this the time to sort of keep your powder dry? And what's the strategy with which you're going? Should people be sort of booking some profits, raising cash in the portfolio, and get ready to redeploy? What's the advice?
In fact, the advice is to do everything. So it's a very interesting advice, because the way we are approaching it is that all of us are searching for a big negative catalyst to bring down the markets. Now, in the absence of any big negative catalyst at this juncture, the idea is to participate through various mechanisms. So what we're doing is that we are taking an approach that certain sectors which look still reasonable and may not necessarily be high growth sectors, We need to perhaps have some positions there. Second thing is, when I say those sectors are sectors like financials, right, which haven't really performed, where growth is not necessarily very high, but valuations are fine. Similar is the case of ID services. The second sort of a bucket for us is essentially look at high growth sectors, which are very high PE, but where there is potential for, as I call it as a new term, non-linearity, where high growth can last for slightly longer, or they get new opportunities because they're in certain sectors which offer you new opportunities, and suddenly you actually see that growth, let's say 30%, remaining at 30% for another year. So we are actually sort of in that bucket of those stocks that we essentially push. It is not just high growth. It is high growth with non-linearity, which is what we push as a second bucket, in terms of the stocks that we would look at. And the third aspect is, yes, wherever you feel uncomfortable with the growth valuation equation, start to trim down a bit. It's a combination of all that we choose when we build a portfolio as well.
And by the way, Venu has, I think recently, not that recent as well, but he's got a small cap portfolio as well, right? I think you got names like Dixon, Keynes, Muthoot was the latest edition, and I think there's one more there as part of that grouping.
Yeah.
Sona Comstar, yes, that one. Just something you were talking about earlier, Venu, I want to just sort of ask you to explain that a little bit more. You're saying whenever the market kind of starts to come off, it won't be anything big. It's just valuations which will start to taper off, right? Now, what you're implying is that earnings estimates are not, typically at this phase of the market, earnings estimates become a little unrealistic, which is what you're saying is that has not happened. It's P multiples which have been taken through the roof. So it's a little different from what we've seen in prior cycles, right? Especially at this phase of the market. So when we say, for example, we put out post-quarter earnings reviews and we say, well, earnings have not, in some cases, beaten, but they're not even beating those sort of moderate earnings expectations anymore. It's not just, the bar is not very high in that sense because estimates are not crazy. Estimates are reasonable. It's P's which are through the roof. Just explain that. Yeah.
Yeah, Prashant, the interesting point that you noticed. So I'll tell you an interesting story around this. Let's say 15 years back, previous cycle, which is perhaps the first mean cycle that we saw, and this sort of investment community was also smaller and perhaps just starting to understand how to professionally look at equity markets, used to be very embarrassed to put 20x Ps or 25x Ps on stocks. That's a fundamental reality. We have tried doing that during that phase in the peak of the cycle, and we used to get slammed, both by investors who used to actually question us on the rationale of a high P such as 20-25x. At the same time, even trying to internally approve these sort of valuation metrics used to be very difficult. So what the market used to do in that embarrassment of not being able to put very high Ps, they used to take up earnings growth. So the previous cycle, what happened is as we moved up all the way to FY 07-08, the earnings became frothy because that was the only way to justify your stock price targets or stock prices. And then when the collapse happened for various factors, cyclical factors and other factors that we all already know, there was pretty massive earnings downgrades that we saw at that point of time. Now, the difference with this time is that people are a bit more liberal. I don't feel embarrassed putting 100x P rate on stocks. Nobody questions me. People feel happy about it. And the same is the situation 50, 70, 80x P. So now we don't really need to keep very high earnings for the next 2 years. The other opportunity that analysts are using is using FY28, FY29. These creative mechanisms used to be slammed earlier. So
sure. Venu, yeah, I hear you, completely hear you and get your point that there are different ways of justifying the rise in stock prices, right? But I have a very simple fundamental question. And, they say that markets can stay irrational far longer than someone can stay liquid. So now if you're saying it's the beginning of phase 3, this phase of invincibility, the question is that given the extent of domestic liquidity, just the amount of money pumping through the system, could this continue for a whole while longer? And so therefore, should one participate knowing fully well this is perhaps a phase of irrationality we are in? Who's to say this turns tomorrow? Because, I mean, standing in front of a wall of money is like standing in front of a speeding train, isn't it?
Well, that's right. And that's the reason why our broader philosophy is to stay invested, but then alter your portfolio in such a way that you don't end up taking risk on low quality companies. Right? That's like the tricky thing. We're okay with high valuation companies as long as they're high quality or have a visibility for growth. So that's the only difference. And number two, remember that when liquidity is there, liquidity finds a way to get sucked, which primarily means you're going to see an acceleration in fundraising cycle as well. And not all of the fundraising will be high quality.
Okay. Just to pull on that earlier thread, Venu, you said that 100p, nobody's embarrassed anymore of putting 100p, right? And using, you were saying, using creative methods like using FY28, FY29 earnings estimates. So if you want to finish that point, or if you've already done, my question is it also because people are, in terms of their holdings, we say that, well, people are becoming long-term investors, right? Nothing matters. But actually, you will only use FY28 and FY29 if you don't really care about FY28 and FY29. If you are confident that you will be able to justify something so that you can make money very quickly. In 3-4 months, you're able to make a lot of money, which has been happening in many stocks. Just respond to that.
Yeah, that's right. See, investment horizons over the years that I've seen, last 20, 25 odd years, is essentially shortened quite materially. So the focus usually is on the near term in terms of earnings momentum and growth, right? So you really don't know what stocks which are generating 30% growth today will actually be 0% growth 4 years from now. But it's a classic extrapolation that you can do and then easily justify a target price today, right? Which primarily is a factor which is being done across the board, across investor base, across sell-side analysts, right? So that becomes easy to then justify sort of creating that narrative around stories. So that's again another factor, right? If you're very near-term looking, then you don't really look at what is priced in for the long term. We typically publish a reverse DCF trying to explain that, hey, you can't have 25% growth for the next 30 years for this particular stock, right? Even if it has 35% growth today. So these questions are usually less asked when your horizons are very small in terms of investments.
Venu, just one last question. Sorry, I'm just completely now changing track, but very interesting sort of, way to look at things and what is going on. Putting some historical context into it as well. Elections, we are into election season, right? And some are saying, well, general elections was barely a speed bump, so why should state elections matter? Others are saying, well, especially a big state like Maharashtra does matter. In a month and a half, we'll be into it. And the ruling party seems to be on the back foot, clear back foot, at least right now, and things may change. Just are you getting any questions from investors on this stuff at all?
Yeah, so earlier state elections used to be not focused much, but actually we're getting a lot of questions these days on this because I think it is more to do with the fact that if the mandate state to state turns weaker for the ruling government, then what does it mean with respect to broader thinking around subsidy allocations or new subsidy schemes? I think this government has done an excellent job with respect to managing the budget fairly well. They did increase subsidies, but to an extent it was still within the broader mechanisms of fiscal deficit reduction. But then it did come at the cost of not being able to increase capex beyond what we was earlier thought. So, right. So the market is weighing between capex versus subsidies and how that goes over the next 12 to 18 months. So that's why they're focusing a bit more on this time.
Venu, we'll leave it there. Thank you very much for joining us. Great speaking with you. Appreciate your time here on CNBC TV18.